Welcome back to Morning Trade Live. Time to go inside out on Target and Walmart ahead of the company's earnings that are due out this week. Christine Short, head of corporate events research at Wall Street Horizon, a TMX company, is joining me now. So we'll start with Target. What is it that you're watching for when it comes to Target tomorrow morning?
Yeah, so we know Target's had a rough few quarters, right? And even before sort of some of the tariff headwinds were happening, Target was struggling, especially when compared to peers like Walmart. And, no different if you look at the expectations for tomorrow morning, sell-side analysts are expecting year-over-year earnings per share to be down and on both the top and bottom line, really. And this would be the fourth consecutive quarter of negative earnings growth, third consecutive quarter of negative sales growth. And if we recall from first quarter, they came and cut their full year outlook because some of these headwinds, both the uncertain consumer, the tariff uncertainty, and some of the other things that they were dealing with internally. They do have a plan in place. They said they are trying to price protect. That is sort of their last resort with these tariffs, is raising prices. They're looking at product mix and moving production into different countries outside of China. And they're looking at some other, timing of orders and things of that nature. So there is a plan in place. And with the further pause on Chinese tariffs announced last week, it does give them a little bit of a longer runway. But I'd expect it to be another rough quarter for Target. But I'm specifically looking at the response to tariffs, how they plan for the rest of the year. Their commentary on the health of the U.S. consumer. We are in the back to school shopping season. Some kids have already started. So how is that going for them? And then lastly, CapEx. They're invested heavily into their online marketplace, their third-party sellers to compete with Walmart and Amazon. What does CapEx spending look specifically in regards to the online marketplace?
Bank of America actually agrees with you here just about the hurdles that Target is facing, also noting the deterioration of partnerships, including the plans to end the collaboration with Ulta Beauty. That was one thing they noted. They said overall that Target has been underperforming its peers when it comes to sales or digital growth and investments, and also has higher exposure to tariffs, like you're saying, versus that of Walmart, for example. So, is there any sort of bright spot here for Target when it certainly seems like there's a downgrade here? They downgraded the stock to an underperform from a neutral and reduced the price target to $93 from $105. It just, seems like there's a lot of headwinds for Target at this moment.
You're right. And like I said, they've been taking the steps, but it just takes a while. So if you compare to Walmart, which gets two-thirds of their goods are produced here in the US, Target, it's about 50%. So they're dealing with more of those tariff headwinds. Specifically from China, though, they have brought down exposure to about 30%. In 2017, they had about 60% of inventory was from China. So they're bringing that down. Their CCO, Robert Gomez, says expected to hit 25% by the end of the year. And they are looking for production in other countries. And so, again, firing on all cylinders there, trying to negotiate with vendors. But it doesn't happen overnight, and it's taken them longer. Of course, Walmart already was in a better position, and they also have a better chance of negotiating. I think I'd also like to point to their grocery business. We know consumers are very value focused and focused on necessities right now. Walmart gets about 60% of their revenues from their grocery business versus Target, which is only about 20% of revenues came from food and beverage last year. So if you're looking specifically at that segment, and it's the only segment that Target saw growth in Q1. Everything else, you pointed out, the Ulta partnership, beauty was down year over year, apparel was down, household items, even household necessities were down, but home decor, things of that nature, hard lines, all were down. Only food and beverage was up, but it's a small sliver of their business. So again, the headwinds are racking up. I think the biggest thing for Target is the health of the consumer. And we know right now the consumer's in a little bit of a precarious place. We've got jobs softening. We've got a nervous consumer. We know that the consumer will spend despite inflation. We've seen this. The consumer can be resilient in the face of higher prices, but if they feel their job is in jeopardy or their ability to find another job in the next 12 months could be difficult, they're going to hold back a little bit. Now, we are in our second biggest spending season of the year after the winter holidays. Back to school is quite a active season for U.S. consumers. The National Retail Federation said in their survey, expect families to spend about $858. That is down from 2024 back to school spending when we saw about $875 spent per household, but still quite a high number. And a lot of families are expecting to buy electronics, higher priced electronics and apparel. So perhaps that could boost Target. But like you said, the headwinds at this point going into the end of the year are still quite great.
Right, and you had the concern about the consumer, and for example, we saw from Home Depot, they said traffic declined, but one bright spot was that the new tax laws may in fact give folks a more disposable income, and that may be helpful to all the shopping places. That being said, here for Walmart, it's a better chart than Target. If you look at it there, Evercore and Guggenheim have $110 and $115 price targets, so they seem like there's some upwards potential. A final thought on Walmart quickly.
Yeah, the sell side likes Walmart coming into this earnings season. EPS expected to grow 9% year over year, revenues 4%. And like I said, they've really been the winner in this environment because they do offer the value. Customers go to them because they believe they are getting, the best price. It's also a one-stop shop. You can get groceries and necessities, but you can also spend some of that discretionary income. Of course, these tax laws help to give customers more money in their pocket, but it doesn't change the fact that they are trying to hold on to more of it and they're more value driven. So they're going to go somewhere where they think they're getting the best deal. And I believe that's going to be Walmart because it has been for several quarters now.
Christine Short, Wall Street Horizon, thank you very much. Good luck there, both Walmart and Target. And we're going to start with Walmart. Tom White is here, host of Fast Market, and we're taking a look at an example trade. I just noted some of the analysts have higher price targets than where it is right now. What's your example trade for Walmart ahead of the company's earnings, Tom?
Yeah, going into this earnings report, implied volatility levels, Nicole, aren't that elevated, to be honest with you, but they typically aren't in Walmart. It's got a lot of share float out there, so it's a big barge trying to turn as far as direction goes. You got to take that into consideration. The option market only pricing in about a plus or minus 4.5% move in the shares either way. Stock's moving up here, just a couple, 2-3% off of those all-time highs that we saw of $103 or $105.30 in February. So maybe elevated optimism going into this report. So I looked at something that gives me a cheap way to gain exposure to the upside. And I looked at a call calendar here where I can take advantage of those differentiation between the implied volatility levels in different option series. So looked at a 2-week wide call calendar to the upside going out to the September 5th weekly options that expire in 17 days. Buy the 105 strike call, that's about $3 above the current share price, and then sell that same 105 strike call in the near-term August 22nd weekly options that expire in 3 days. You're only paying a debit of around 40 cents for this, so that's going to be your risk, about $40 on this trade that gives you that upside exposure. But you can see here from the risk profile, while the apex of profitability is at or near that 105 strike where you're doing the 2-week wide calendar, at the same time, you've got a range between maybe 100 on the downside and about 110 on the upside to remain profitable on this trade. And that's well within that one standard deviation move that the option market's pricing in of just over $4 either way at this point. But you do need to move to the upside. This is just a cheap way to gain exposure to the upside because you're buying a lower implied volatility in that September 5th weekly 105 strike call as opposed to what you're selling in the near-term August 22nd weekly options that expire in 3 days and that have the earnings event.
Understood. What do you think about Target then? Because we talked about how Walmart was a more favorable play for Wall Street, analysts on Wall Street. Target has had more headwinds. Your thoughts on an example trade on Target? How would you go about that?
Well, the first thing that sticks out to me with Target going into these earnings is the underperformance that the stock's had over the last couple of years, not only to its sector, to its peers, to the retail space in general, whether it's discount or upscale. Target's been struggling trying to turn this boat around. The option market's pricing in about a plus or minus 8.5% move, about $9 either way in this stock. It's had some downgrades recently, but then was named a tactical outperformer this morning. So a lot of bifurcation as far as the analyst community goes. So I looked at a strategy, and one of the things that sticks out to me is the dividend yield, about 4.3% dividend yield on this one. The hope is that they keep that dividend up there and they do not cut it. Because the profitability of this company versus what they pay out, it's getting close. But if you think that they're going to continue to pay this 4.3% dividend yield, this strategy takes advantage of it. So I looked at a neutral to bullish covered call strategy. I went pretty aggressive on the strike. So for every 100 shares of stock you buy, you sell an out of the money call to the upside. I only went up to the 108 strike call on this one. You're going to pay a debit in total of about $102.30. It might be a little bit higher than that right now, maybe $102.50 on this. But the debit you pay is also going to be your break even. So you're buying the shares at a discount of about 4% to the downside on this. So buying the shares at a discount, it caps your gains to the upside. You can see here from Nicole from the risk profile, but at the same time, maybe the stock kind of consolidates, maybe it goes a little bit lower. But even if it does pop up, you're still going to be profitable on this trade. It just gives you a big cushion of about 4% to the downside before you start getting hurt on this. You do have a lot of capital because you're buying the shares of stock, but trying to take advantage of yield, not only in that short call that you're selling in the August 22nd weekly options on that 108 strike because volatility is elevated, but also collecting yield from the dividend because you own the shares.
All right, Tom White, a good look at two key names here on Wall Street, Target and Walmart, both due to report over the next couple of days. Lots of retailers that we'll be focusing on. Tom White, thank you for those example trades.